Good day, everyone, and welcome to the premium video newsletter for September 5th, 2013. Lots of interesting and substantial things going on right now. So let's dive right into the fundamentals and work our way into the technicals from there. Today, I think we had the most fundamental news we've had in a very long time. I won't bore you with the specifics and give you the broad picture, so we can move on to more interesting topics. The number of Americans seeking unemployment benefits dropped last week, and it's near the lowest level since June of 2008. Weekly applications are just 1,000 above a 5-year low reached last month. So there's lots of evidence that the employment situation in this country is definitely improving. A survey from the payroll company ADP showed that American businesses added 176,000 jobs in August, fewer than in June and July, but roughly in line with the monthly average for the year. This is very important because remember, tomorrow we have the employment numbers from the feds, and this is going to be very important as we discussed during yesterday's session. On a separate note, official data showed that U.S. factory orders fell only 2.4% in July, less than the expectation of 3.3%. Retailers reported modest gains for August, and there were some higher sales from major chain stores. However, there is strong fear that the winter season will be weaker than expected. There's evidence that Americans are beginning to juggle between expensive goods such as cars and cheaper goods such as clothing. But the growth is not consistent across the board. This usually occurs at the beginning of a recovery cycle, and that's where we're at right now. We may be seeing a hard time for this sector in the coming months, and I'll keep an eye on it as well on a regular basis. The Institute of Supply Management said that its non-manufacturing purchasers managers index rose to 58.6 in August from a reading of 56 the previous month, hitting the 29-month, that's the 29-month high. That's just wonderful news and more evidence of growth. Analysts had expected the index to fall to 55 last month, so we're way above estimates. Yesterday, I mentioned that the markets are giving us mixed signals. The reason I mentioned this is a few markets had strong technical sell setups and very strong fundamentals towards the upside. Today, we're getting a bit more clarity, as I will explain. The 10-year Treasury note fell to the lowest level since July 2011. Prices are lower in spite of news that the Senate Foreign Relations Committee yesterday backed a resolution for a military strike against the Syrian government. Remember, if we attack Syria and go to war, interest rates should go down, not up. But we're seeing an opposite effect. The reason we're seeing this is because the fear of cutting the stimuli in the next few weeks is having a stronger effect on the bond market than the potential attack on Syria. As you know, I've been ranting for the last several months about the bond market going lower, and I've been short for several months as well. Also, keep in mind, the bond market is very forgiving and is historically very range-bound. So you may have another bite at the apple if you're looking to go short, meaning we will probably have a retracement to the 124.5 area or maybe a bit higher. My analysis about this market going back into a trending cycle from a range-bound cycle seemed accurate. Let's keep an eye on the downside and see how wide the range bars are going to get. I want to see how much emotion and commitment is behind this move. Another market that was giving us strong mixed signals was the gold market. If you recall, about 5 days ago, I called an island top reversal on the gold market. As I explained a few days back, island reversals are fairly accurate reversal patterns, so I was expecting lower prices. When we got the setup on gold a few days back, I warned you that the upside was limited and encouraged you not to take the trade to the upside. The market broke down as we expected, but we began rallying the last few days due to the fear of attacking Syria. So we had a similar situation that we saw with the bond market. The technicals were pointing down and the fundamentals were pointing up. Fortunately for us, the technicals win about 8 out of 10 times, and gold is moving down to another level today as we anticipated when we saw the island reversal pattern 5 days back. Watch the 1350 level, and if we break through it, I think we will probably end up between the 1316 and the 1300 level for some time. The Swiss franc, as well as the euro, which are extremely correlated, are continuing their decline, primarily due to the strength in the US dollar, which continues to rally today based on the positive economic data we're seeing. This offers strong evidence that the stimuli tapering will begin as planned during the next few weeks, and more importantly, it's showing us that the US economy is strong enough to overcome Syria, at least at this time. There's no secret why the foreign currencies are moving lower. Money is flowing into the dollar because investors are going to get higher interest yields, as we saw today by the 25-month low on bond prices. Remember, bonds are inverse to interest rates, so the lower bonds go, the higher interest rates get. So we're seeing money coming out of the foreign markets and into the dollar. This will continue for some time if the bond market continues to fall. And all you have to do is go back a few weeks and watch my analysis to see the long-term view of the bond market. If you recall, I suggested that the 10-year note has a lot of downside to go, and we just started breaking. If my analysis is correct, and we continue to see positive economic data from the US, and we see the impact of Syria is not being too damaging, we may see the euro at the 1.045 to the 1.050 level within the next few weeks. I wanted to discuss the stock market after I gave you the world market analysis because much of what's happening in the world is having major impact on the stock market right now. Also, because the fundamentals are so mixed right now, we have to rely more on the technicals and sector analysis because ultimately this is what determines what happens next more than anything else. If you recall last week, I alerted you to the transports and the Russell 2000 when I saw a potential downside break. Remember, these are the two subsectors that rallied before the broad market on the way up, and they tend to move down before the broad market as well. Today, for the first time, we saw the transports reach the 50-day moving average, and if we continue to move in that direction, it will help strengthen the broad market and help move the S&P above the 50-day moving average as well. Further, we also looked at the Russell, and we're seeing the same thing. The small caps are reaching and trying to move back above the 50-day moving average. So we're seeing some consistency here as well. But remember, the broad market is still below the 50-day moving average, and we have a downtrend developing right now. So if I see continued strength in the subsectors, we may be able to rally and move above the 50-day moving average. However, we are not out of the woods just yet, and higher interest rates are not good for the stock market. Also, September is not a good month for stock prices. This, taken into account with the fact that we're still below the 50-day moving average, makes me very nervous about taking long positions in the broad market at this time. The NASDAQ market has much less slope than the broad market, and therefore has much more relative strength compared to the broad market. As we discussed yesterday, if we didn't know any better, we would think Syria is nowhere in the picture by looking at this chart. However, one index is going to pull the other one up or vice versa. I'm still bearish because the broad market has much more capitalization than the NASDAQ, and the bonds are moving lower. To me, there's more evidence of a bearish move than a bullish move in the big scheme of things, meaning the second half of this year. I don't think that US has enough strength to battle war without having government putting in $85 billion per month into the economy at the same time. We're not that strong just yet without the government. We're just beginning to stand on our own 2 feet. So don't get too bullish on the stock market just yet, especially in light of the fact that the $85 billion a month we saw going into the economy is not going to be there much longer. There are 2 setups, and I want to make sure you understand that the markets are very uncertain right now, and you need to be very careful before initiating these positions. The setup is a 4x4 to the upside, and the ticker symbol is UBNT. Place a buy stop 15 cents above today's high, and if filled, place a sell stop 15 cents below today's low. The second setup is a 4x4 to the downside. The ticker symbol is CLVS. Place a sell stop 15 cents below today's low, and if filled, place a buy stop 15 cents above today's high. That's it for today's session. I will update you midday tomorrow and earlier if I see something unforeseeable. Have a great night, everyone.